Market View presentation by Lachlan Hine, Marino, and Ned Warner. In this, we will be analysing AUD/USD, AUD, and the Japanese yen. We will be looking at this through commodities, interest rates, and inflation rates.
Commodities. A commodity is a basic good used in commerce that is interchangeable with other commodities of the same type. Commodities are most often used as inputs in the production of other goods and services. Gold, AUD versus USD. Australian dollar is positively correlated with gold because Australia is one of the world's biggest gold producers. Its dollar tends to move in unison with price changes in gold bullion. Thus, when gold prices rise significantly, the Australian dollar will also be expected to appreciate against other major currencies. The price of gold is generally inversely related to the value of the US dollar. A stronger US dollar tends to keep the price of gold lower and more controlled. A weaker US dollar is more likely to drive the price of gold higher and be more sporadic. This is because people have a tendency to invest and trade in dollars when the dollar is strong and stable. During times of economic uncertainty and when the dollar is weak, people, however, prefer to invest in gold through vehicles such as gold funds or coins. So as the US dollar drops, the price of gold increases as more people look to invest in it due to the fact there is no such thing as a safe currency. If you have a look on the graph on the left here, the US dollar versus gold prices, the US dollar is in black, and as it drops, there are spikes in the gold prices in the red, so stating that it rises when the US dollar is weaker. And if you have a look on the graph on the right, the gold versus the AUD versus USD price over the last 11 years, you can see the gold majorly increases when the dollar is on a downward slope. The Australia-Japanese relationship. The Japan-Australia Economic Partnership Agreement consists of two treaties. The agreement between Australia and Japan for economic partnership and its implementing agreement, according to the Department of Foreign Affairs and Trade. Japan's Ministry of Economy, Trade and Industry releases data for Japanese iron ore imports on a monthly basis. Japan's iron ore imports totaled 11.6 million tonnes in March. This is 6.8% higher compared to February's 10.9 million tonnes and 7% higher than the year-on-year average. Australia was the largest exporter to Japan during March. Its imports from Australia totaled 6.7 million tonnes, forming 58% of its total iron ore imports. Iron ore imports. As you can see on the pie chart on the left, this is the exports. 69% of all Australian iron ore exports head off to China, while the second biggest is Japan at 18%. And Australia's total exports, iron ore makes up 14.9% of it, but equals $34.2 billion. Due to the nature of Japan being a secondary producer, as they need to import vast materials in order for them to produce goods and services. Over the last few years, the price of iron ore has dropped significantly, allowing for the yen to increase against the AUD, due to the fact that it has been cheaper to import these goods. As well as the implementation of free trade agreements, Japan has been able to import more resources cheaper, allowing for their dollar to rise as their economy increases. If you have a look at the graph on the top, as you can see from last July when the free trade agreement was agreed to, the Japanese yen has increased significantly over time. And as you can see, the iron ore prices per tonne in US dollars has dropped quite significantly over the past 4 years.
In terms of exchange rates, it's usually the nation with the higher interest rates that enjoy a relative appreciation of their currency. An increase in the nation's interest rates usually leads to a rise in capital inflow, which increases demand for the currency, whilst discouraging capital outflow, decreasing the supply of a nation's currency. The higher interest rates makes investment more attractive to overseas investors, whilst encouraging local investors to invest in the domestic market. This occurs because higher interest rates allow investors to claim their greater returns on their investments, making it a viable option to invest in banks with high interest rates. This increases demand for a nation's currency whilst decreasing supply, and therefore leads to an appreciation of the currency. As of July 2017, Japan has a negative 0.1 interest rate, which is considered very low. This sees banks paying interest where they should be earning interest, and can be detrimental to the success of an economy. The negative interest rate sees central banks charging depositors interest to keep their money in the bank, instead of paying out interest to those investors, whilst they are made to pay interest on borrowers on loans. This makes Japanese banks unappealing to Japanese and overseas investors, seeing them invest their money elsewhere. Meanwhile, according to the Australian Bureau of Statistics, Australia's cash rate is steadily sitting at 1.5%, which is significantly higher than Japan's. Although Australia's interest rates are relatively low, a rational investor would choose to invest in Australian banks over Japanese banks, as they will enjoy higher returns. This leads to an increase in demand for the AUD and a decrease in supply, therefore seeing the AUD appreciate against the Japanese yen. As shown in the chart above, it is clear Japan's interest rates have been decreasing over the last decade. This shows that Australian interest rates are likely to stay well above that of Japan in the future, allowing a conclusion to be made that the AUD will remain stronger than the Japanese yen for months to come. The AUD and the USD. In the meeting on September 6, 2017, the RBA decided to keep Australia's target cash rate at 1.5%, as the board believes that holding this stance of monetary policy will be consistent with sustainable economic growth. The Federal Reserve has set the US interest rates at 1.25%, whilst they have also set the stage for an increase towards the end of 2017. Due to the current stance of both central banks, it is likely that investors will decide to invest their money in Australian banks, as higher returns are guaranteed compared to living in United States banks. As shown in the RBA board statements, as the Australian cash rate has been slowly decreasing over the past 5 years, whilst the US rate is set to rise in the near future. This allows us to estimate that the AUD will rise in the near future against the USD until the US rises interest rates, which will see the USD increase back against the AUD within the next 6 months. As shown in the graph on the top right, it is shown that the AUD is consistently rising against the USD in the past year or so.
Currently, inflation rates in Australia are 1.9% as of June 2017, according to the Australian Bureau of Statistics. The Australian inflation rate has increased from 1% in June 2016, although there has been a decline from 2.1% as of March this year. For the past couple of years, there has been fluctuations but no serious deviations. There has been respectively a high and low of 3 and 1% since the start of 2013, and it can be expected for this to continue. Currently, the Japanese interest rate is 0.4% as of June 2017, according to the Bank of Japan. The Japanese inflation rate has been relatively weak as firms have cautious stances for wages and price setting. However, it can be expected there will be a rise in inflation as continuing favourable economic conditions encourage firms to raise prices and wages. Because the rate of inflation is lower in Japan than Australia, their exports are more internationally competitive, and accordingly it can be expected for there to be an increase in demand for the Japanese yen to purchase Japanese goods. This increase in demand will raise the supply of AUD and a lower supply of Japanese yen, leading to a depreciation in the Australian dollar and appreciation of the Japanese yen. This is reflected on the graph on the left, with the graph on the left of the Australian inflation rate, and the graph on the right with the Japanese inflation rate. Currently, the US inflation rate is 1.9% as of August 2017. America is at this stage experiencing sluggish rates of inflation as they have once again failed to meet their expectations of 2%. This can be accounted for by cautious consumer expenditure and business investment despite strong job growth. This has been motivated by the uncertainty surrounding the new government after the federal elections and other economic conditions. It is the opinion of the Federal Reserve officials that a rise is forthcoming. However, continual failures to meet their target and no indication of an increase, this still remains unlikely. The inflation rates of both the US and Australia are approximately equal. However, in the future, there is an expectation that the American inflation rate will fall whilst the Australian will rise. Countries with a lower inflation rate will expect to see an appreciation of their currency, so in this case the US will experience the appreciation as demand increases for the USD to purchase cheaper US exports.
Being Christian's, Lachlan's and Ned's market view presentation.